Well, happy Thursday, everybody. Thank you for being here. And this is I think, a nice little event to come out. It's amazing how we scheduled this. We have in-house Don Kaufman, resident, listen to me, resident expert, all-around good guy from TD Ameritrade's Thinkorswim. Right now, I just want to pause and say, and double check to make sure our sound quality is good on my end. So how does the sound to you guys sound from my voice level? Good. All right. Hey, Don, I'm going to pass the sound check to you if you want to just say hello.
Sure. How you doing?
Perfect. So I'm sure everyone, the majority of folks here are friends in the community of Thinkorswim. Generally, in our own trading room, we do a special Tuesday. We call it Tuesday TOS Day. I mean, every day is almost a TOS day, but Tuesdays we kind of go through a few techniques of what we use with Thinkorswim, and of course, as an options platform. I mean, I don't need to say anything more about it. I think everyone else will type in their views. It's always best to hear it from the audience anyway. So with that said, I don't think it's my mic fading in and out as much as it is my voice. But anyway, we'll try to make sure that the sound quality is good. A couple first announcements. Number one, this session is being recorded. Number one. Number two, Don and I didn't really sit there and plan any particular trades. And number three, we're going to just see where taking my style of analytics and matching with Don's knowledge of how to apply information and how he uses the Thinkorswim platform, especially I think an overlooked process is in the Analyze tab. And I guess what it is with options traders or any trader, a lot of people, and this has been a very, Don, I'm going to let you kind of chime in here too. It's been a very tricky market. It's been a sideways market since literally March. I mean, it's been, with a couple breaks up and down, low volatility. A lot of other markets aren't, one day everything's in sync, like gold and bonds. Stocks go down, bonds, gold go up, and then recently we kind of lost that. If you notice this week, we lost that. Bonds didn't believe this, the little breakdown the other day, and they had a little reversal off that 138.04 exact high. In any event, I think that one of our messages, we did an open house a couple weeks, and I know there's a lot of familiar names here. And one of the messages then, and it's been a rough and rocky road, but it finally came to fruition, was looking at the strength coming into the Qs, the NASDAQ 100. And part of that, what we were looking at was maybe a recovery in some of the biotech names, which a lot of people aren't familiar with. What does an index, what is it comprised of? And when you ask a lot of people and you say, well, I'm looking at the technology sector, and they think, well, the ETF of the XLK, or they naturally think of the Qs, the NASDAQ 100. And the reality is it's a mixed index. It's not really a pure technology index. But in any event, there is some components within the NASDAQ 100 that we do see seasonal strength. Many of you are familiar with the fact that I've co-authored and edited the Commodity Traders Almanac, and I do a lot of work with seasonal analysis, seasonal studies, and sector analysis. So with that said, there are some lively sectors that stay strong, and some of those are a couple names that we're going to go into today. One is Starbucks, actually. Starbucks really is a stock that starts a strong seasonal run from on or about, I don't want to be too precise, but it's the 24th of May going into about, to be exact, July 6th. Why, I don't know, but on average, that is a typical time period where you see strength in Starbucks. With the fact that Starbucks is a component or one of the stocks listed in the Qs, there's other names that I think are relative to the overall performance of the market and the fact that we do see seasonal strength, and one of them is actually Akamai Technologies. And one of the things that I'd love to even take a poll of the audience, how many people have heard anything out of Akamai? It's not one of those stocks that are in the news quite yet, and I think, Don, would agree to this, that the stocks that are in the news are always the stocks after the fact, right? They've had, look at this move, and no one really talks about what could come. And I think one of the things that we want to be focused in on for the next 6 weeks, and this is where this could be instrumental, is with an options trade or finding the trade idea, the next is duration. What's the length of time we need to be in this trade? And then what's the best strategy that we can come up with? And there's so many different option analytics that we need to know. And for one, if you got a great idea of a direction of a stock play and you've got some really good, strong analytic technical tools that confirm that, now you've got this secondary level of analysis to do and find out, is the stock optionable? If it is optionable, is it liquid? Do they have a tight bid and ask? What's the implied volatility compared to historic volatility, to find out what the best strategy is? So there is a checklist that grows with using options, but of course, if you're doing and you have limited funds, options obviously can help you to capitalize on a trade with using less money, and of course you can also come up with defined risk strategies. So with that said, I'm kind of happy about today and where we can go with this. The first thing I've got on my screen here is Yelp. And the funny thing is, the other day we came up with this strategy in Yelp, and we came up with the idea of doing, now I'm not going to talk about well, actually, on a shorter term time scale, one of the things we came up with was the fact that Yelp on a daily chart had a strong buy signal in the form of a high closed doji, and then we had this little generated PPS buy signal. Everything that you see on your screen, this is the what we see here is the monthly person's pivots and the person's pivot indicator, and these little arrows indicate buy or bullish and bearish signals, right? So underneath that, we have the volume histogram, which I find in this day and age probably one of the most useless tools for defining the health of a trend. I think it's very misleading, and that's just my opinion and my experience. And one of the main reasons I find volume histogram to be a very misleading tool is the fact that you've got more and more people with using derivative products like options and dark pools, and there's all ways that we could set to mask the true volume of a product. And I think what we are seeing is that a better tool that I like to share with people is using Joe Granville's on-balance volume indicator. And I know there will be some technicians out there say that he didn't create it, but he's credited with popularizing it. And the whole issue here is not the nitty-gritty details, but it's how we use this type of information to confirm a trade. Well, first off, I think a lot of these big names in the momentum stocks, and we can go on down from, the surprise being Zillow at the bottom of my screen, big Z there. 2 weeks ago, I think Investors Business Daily, someone typed in before earnings that they said that stock was going to go down. It was trading at 93, and obviously it's not at 93 anymore. There are certain tools out there, just like I'm sharing with you right now, on balance volume, which will probably help give you a better, truer sense of market condition. This is just a recent example of, as you can tell, the market price is moving lower and volume is going down as well. But notice that the on balance volume, this yellow line, is moving up in the trend direction. Price is actually moving sideways during this time frame, but the volume accumulation, as indicated with the on-balance volume indicator, is rising. So that's a very healthy, if you believe in the term volume precedes price, then this was reflecting that there was accumulation of buyers in the market. And that's why we came up with the idea. I thought this market would stay in a trading range, and we've got, we had time coming in for the June expiration, and we had a 3-day holiday coming up, and of course the market popped up, and I felt more comfortable taking a quick profit on the trade. And as you can see, the market's continued to give, even with today. Now, I want to focus in on this little pattern, the high closed doji. It's where we see a doji and the market closes above the high of the doji. You have a doji and the market closes above the high of the doji. Because now I'm going to turn this to a weekly chart and I'm going to say, uh-oh, hey, check this out. We have a very similar pattern but on a higher degree time frame. We have a doji potential right here last week, and now tomorrow being Friday, Yelp will be closing above, if of course Friday the market doesn't crash, we'll be closing above the high of that doji. Now we don't have a person's buy signal yet, but high close dojis precede. They give a faster indication of a buy signal than my actual indicator does. The other element of this setup that I like for Yelp is the fact that the on-balance volume indicator has risen. So if we can get a close tomorrow and we start to see the rise in this volume indicator, then number one, I have a good setup that tells me that this price could experience a further gain and potentially, upside for the monthly pivots, $75. That would be a huge move to the minimum of $64, which is another, 7% or so. Now, I think going into next week, we probably, if the market is going to be healthy, we should see a continuation of, as you can see here, higher lows. So in the last 2 weeks, we've made a consecutive series of higher lows, and now we're going to come in with a potential close above that doji high. To me, that is a bullish indication, or at the very least, the descent, the price erosion here has halted. So the fact that there's accumulation of price and volume, this tells me that this is a great little setup going into the next 30-day or option expiration cycle. So with that said, I want to pass the baton because this is the first trade I want to talk about, because I think Yelp, besides Starbucks, and there's a list of a few others that are coming to mind that are showing strength in the market. So Don, I'm going to pass the baton back to you, and let's take a look at first off, taking a look at Yelp, and let's do a walkthrough of how to use the Trade Analyzer tab and see if this thing, what kind of strategy we could come up with for the next 30 days.
All right. So, well, we do have, we've got 30-day options over here. We've got some liquidity because we've got weeklies, and not only weeklies, but multiple weeklies, which I don't know if you guys are aware, but not every product has 5 different weeklies listed on it. Some products are now chosen based on liquidity to have 5 separate weeks. So I just love that. There's a lot of flexibility and variability now in ultimately what you can do with multiple weeklies. So taking a look again at Yelp. Now, John, I can build a bullish trade, I can build a bearish trade, we can build, a number of different positions on here. To me, though, that time frame is going to be kind of imperative on this particular trade. Now, before I go ahead and construct everything, I always open up the option statistics just briefly to get a read on the implied volatility percentile. All that really is doing for me is saying, okay, here's where volatility, implied volatility, has been in the last 52 weeks, a high and a low, and it kind of ranks us of where we currently are. And I'll also glance down at historical volatility. So that's actual stock price movement, which happens to be in the upper end of the range. And just glancing over at the chart on Yelp, you can see just that right now. In essence, to be able to build a trade, another thing that I'll take a glance at is we close up option statistics, and I'm going to look at the weeklies initially with only 22 days. I'm going to show you guys why. The weeklies sometimes carry 50-cent strike increments, dollar strike increments, 50-cent strike increments. That's going to give you, again, more flexibility and variability of what strikes you can select. Versus if you take a look at the June, you're a little bit more limited in June because the strikes are going to jump by $2.50. Then you got to compare and contrast the bid offer spread. All right, so here we are they're 15-cent wide spreads. But you know, a lot of people, they might look at this and they go, oh, that's not that good. That's, you know, 15-cent wide spreads. Most of the time I'd say, yeah, the bid offer spread's a little bit wide in here, but you do have to recognize the increase in implied volatility. Okay, so there's a couple of different aspects I look at. You know, I always glance over at the chart to ultimately get a feel for underlyings that I don't necessarily know very well in terms of volume. But John, I got to tell you, you made a stellar point there with looking at volume as it pertains to equity products. You know, do you really trust the volume that you're seeing on the screen with all the dark liquidity and so forth? So I rather enjoyed that point. But I just look to see that this thing is even trading anything beyond just today, because all I can look at right here on the trade tab is today's volume. Now, to construct the trade, if I want to be 30 days out, I mean, myself, I know there's not a huge amount of volume in these June weeklies, but seeing if I can get a decent fill or execution in here, I might want to select these ultimately in respect to the fact that they've got, again, more flexibility. If you take a look where the stock is trading at 60.50, okay, one of the first things that I always try to construct is kind of what I call like a binary trade. And I'm going to build like one of the most simple examples of a binary trade. I either think it's going up or I think it's going down in a given period. It's a pure directionally biased trade. And I often go back to the well on here and I say, you know, you can risk 50 cents to make 50 cents, or you can risk a buck to be able to make a buck. There's a lot of different trades that we can construct. We can construct a trade to risk 1 to be able to make 3. But there's probabilities associated with that. When I call these the binary trade, it's kind of pure and simple. You're either right or you're wrong, which puts all of that, you know, am I going to make money in this trade in the long run? You know, your directional bias then becomes like, you know, the most paramount portion of your trading. You're really taking, okay, a lot of the risk management and putting it aside. And I say, why are you taking the risk management and putting it aside? This spread, well, the most you can lose is 50 cents. The most you can make is 50 cents or somewhere in between there. And you've roughly speaking got 36 days in essence to be able to do that. You know, I'm using the weeklies with 36 days. It's why I jumped to the weeklies. You can also take a look at a trade like this and you can move it to a shorter duration. And what you're going to find though is shorter duration, it's going to trade for about the same debit. And this one, it does, in fact, happen to be a debit spread. I mean, lots of people like to sell premium. There's nothing at all wrong with selling premium. I'm a huge advocate of premium selling techniques. But in effect, if you're much more directionally biased, you kind of just want to get it done. And if you don't like doing a 50-cent wide spread, please don't. You can switch this up. You can go, you know, use some in-the-money options, use a 59, maybe, let's switch it up here, 59, 60, 50 trade. So this is a $1.50 spread. You can go to a $2 wide spread. Look, it's $2 wide spread for a buck. Risk a buck to be able to make a buck. If you like, you know, a style of trade like this, to look at it on a risk graph, you simply right-click, analyze duplicate trade, and I'll just dump it right into the risk graph. You can see, you know, here's where the underlying is. Effectively, here's my break-even point. Now, it's another aspect I want to point out. Where is Yelp trading right now? And again, if you looked at the price slice, it's trading at $60.50. Now I'm buying a call that's already in the money. Okay, by how much? Well, it's a 59 call with the underlying trading at 60.50. So the call is already in the money by $1.50, but I can probably purchase this spread for just over $1. You can see my credit on the bottom of the screen. You're going to pay a little bit up in here because the bid offer spreads, but you might be able to grab this thing for in the neighborhood of $1.05, $1.07. Might be a more reasonable market. With that, again, you're risking about $1 to make a buck, but the trade does have kind of what we call flat theta. That is, time decay is neither with you nor against you in the trade. It's kind of been negated. And that's why, again, I kind of call it that binary trade that just says, hey, I want us simply up. I maximize profitability with nothing more than a 50-cent move up. again, I can select different time frames and so forth. And this initially throws people a little bit for a loop. Why am I not going for the home run over here? And it's because in this market, predictability, it's become significantly more difficult. We're in low volatility. We've been churning and grinding on a day-to-day basis. This is where I kind of like to, what do they say, use alligator hands, kind of pull your arms in a little bit, not extend a tremendous amount of risk in a low volatility climate, and use very small defined risk trades. So John, I think that's, that's number one. It's just based on, and I built a bullish trade. We could flip this over and construct this thing bearish, but I just wanted to spend a minute talking about, again, what I kind of call that that binary trade, where it's either up a couple bucks, down a couple of bucks. Again, volatility inside of Yelp, there's nothing spectacular to tell you about it. It's, in the rank.
And I think that's, Donnie, I think this is great. This is one of the things that I think most option traders, the first thing they learn is looking at is there any volume? Is it option? Is the stock optionable? You can come up and run scans, and that's one of the things that I personally love about the TOS platform, is that the scanning feature with, shameless plug, my own indicators, the buy signals, they're defined buy signals, they're defined sell signals. Show me at the end of the day, the end of the week, a time period, what stock and what sector is giving me buy or sell signals. And now I can quantify and see if that buy signal is supported by volume, the way I teach. Using the OBV indicator. Second, now I got all that work done, and I switch over to my options tab, and I find out, well, first off, it's not optionable, or second off, it's not liquid enough, and then it's okay, scratch that idea, on to the next. So there are some fabulous ideas out there, but sometimes they're better in theory rather than reality. And so when you come down to it and you look at this type of environment with the VIX trading, gosh, folks, a 12, 13 VIX, and they go, hey, it moved 10%. Well, no wonder. It doesn't take much to move the VIX. The point is, we're in a low volatility environment, and the market's just chopping people alive. The indexes go up, and some stocks go down, or you get these binary. You mentioned the word binary, Donnie, and binary. That's what this whole earnings season is about. It's like, first off, it's a binary play. Is the market going to beat? Is it going to go up? Is it going to go down more than what the strangles have priced in, giving you an idea, or what direction? It really has been a kind of a very choosy market environment. And the first thing you look at is, what is the implied volatility versus the historic volatility? Am I buying an option? Am I getting an edge? And that's the key here. Are we getting an edge in an option writing strategy or an option buying strategy? What would be best suited? And a lot of times we're finding recently, like with looking at Yelp, it's almost like, it's a 50 flip a coin. According to theory books, you don't have a really good edge in buying an option or selling an option strategy, right? So if we're directionally correct in the next 30 days that we could see at least an 8% move in Yelp, what would be the best strategy? And that's what I think is important in how we can come about that. And as Don just showed us, it's 2 clicks to find that out. Yelp, I think, has got an easier, I want to go back and look at the overall cues. So I'm going to take the baton real quick here, Don, and we'll get this moving, because we've got a couple of trades that I think will be kind of interesting to see how we can come up with, and combining your expertise of showing people the platform as well as how I can show them and work together. So let me go over here and stop this real quick from you. Sorry. And I'm going to go over here to start. We're going to flip this right back again. Okay. So now here's the and let me just go over here, and I'll just get rid of this. So we're all looking at pure price here. So this is the cues, and looking at the cues real quick, we're actually closing in on this 90.29. This will be the monthly pivot resistance. And after this month concludes, we get into June, and I would imagine that if you go down here and you want one of the neat change this right expression, and I'm going to change bars to the right. Let me change the bars to the right by, say, 20, and hit enter and go apply and hit OK. All right, so let's say, for example, right now, the market closes. Right now, if this is kind of a neat thing. I've just expanded the right expression, the right side, by giving me a look-see into the future. Now, one thing that the pivots are doing for us right now, it's assuming that if this is the actual high for the month in the Qs and the low, assuming, this is assuming, and I know making assumptions sometimes make an ass out of you and me, but assuming the low for the month is in the Qs, assuming that this is the high, and assuming this is the close, notice that it's giving us a predicted higher high and a higher low for the month of June. So right now already we're getting a bullish bias on a technical basis. And of course the month isn't done, but you know, we're PDQ, or PDC, pretty darn close to the end of the month. And so looking ahead at our analysis, the person's pivot indicator is already giving us an indication that the month of June is going to be bullish for the Qs. Kind of an interesting concept. Looking at the difference between this move that we had, the low of April 15th, that spike low, which turned out, as you can see here, a doji formation, the overall trend of on-balance volume, clearly you can see, is up, whereas the overall volume on histogram bars is clearly down. So I think this is what's confusing people that believe that this rally can't last, or the rally's going to fail and there's no volume. The funny thing is that we are actually breaking out to a new volume high level. So we are seeing this move substantiated or supported by actually some pretty decent volume as represented with the on-balance volume indicator. To me, that's what this is such a great tool, because it defines the trend. In addition to that, we're seeing a potential over the next couple days if we've seen all these false breakouts. One of the things that we've been talking about is way over here. If you go and mark on your piece of paper, folks, April 10th, and go do some analysis on individual stocks. I don't know what it was, but someone hit the light switch on April 10th in a lot of stocks, in a lot of sectors, semis, in the biotech. I mean, the list goes on and on. April 10th was a heck of a down day, and it wasn't until we actually took out that, what we call that April 10th low. The market never saw a close over it traded above it, but it never closed above that level until we got into this day right here. And then all of a sudden we had a little bit of downdraft, and the market came back and gave us one more close. And now we see the market breaking out. My point is that I think that this is going to be the surprise, since we are in a seasonally strong period of time. At the very least, we're calling for a 3% move, which to me, we could actually see over the month of June up to around the 91.5. So we've got a 3.5-day weekend. I'm looking forward to seeing if the market pulls back and we come in here next week, any slight pullback, and as long as the market holds that April 10th low, if we come back and we see a consecutive series of higher lows, watch this real quick. I'm going to change this to a weekly chart. Even on TOS, we generate a weekly buy signal. Note that we have had, since April 28th, we have had consecutive series of higher lows. If the market's bullish, it should make higher highs, higher lows. The close should be greater than the open. You want to see closes greater than past or prior highs. And in the short term, over the last 4 weeks, that's exactly what we have. In addition to that, we have an actual volume breakout. So all I'm saying is, if we are going to continue to see a potential rise in this index over the next 6 weeks, at least going into July, then if we get a pullback, I know that at the very least on the weekly charts, if we're going to continue this bullish momentum, then we shouldn't take out this week's low, should we? Right? Because then it would be a lower low and not. And so if the market pulls back, a slight pullback into next week, maybe 88.31, something like that, that would be an area of interest that I have, looking for a pullback going forward for an upside bias. So virtually, is it an opportunity tomorrow to maybe do a calendar spread by selling slight out of the money call for June and buying the July? Because I think that we will still see upside bias, but maybe it's going to take a little bit more time. So we have a very good opportunity there number one in the queue. So I'm going to pass the baton to Don in just a second. One of the strategies or markets that I want to talk about, because I've been beating this one up to death, and I probably had too much of it today, it's Starbucks coffee. So I want to examine this together with you because this is a textbook example of what I try to show people, that where volume analysis is probably hurting people more than helping people. I mean, I'm simply drawing a trend line. I'm not inventing this stuff, and I didn't create this yellow squiggly line. This is on the TOS platform. This is the on-balance volume indicator, and clearly you can see that the overall trend of this volume is higher, whereas the overall trend on volume histogram is down. So when you look at the trend of the market, you go, yeah, this thing looks a little ugly. Let me go over here to studies. I'm going to edit studies real quick. I'm going to get rid of the pivots I'm going to not show it. I'm going to hit OK and apply it, and good to go. Now we can see just price action. That's what I want to get into. So the funny thing is that Starbucks, you know, I don't think a lot of people have Starbucks on their minds today. But the interesting aspect about Starbucks is we're seasonality helping us to derive a market directional idea. And since Starbucks is probably not on everyone's mind, it's under the radar, and that's what I like to look for, stocks that no one else has picked out yet. And for one, Starbucks is I have a strong interest because what has it started to develop in the last 3 weeks? We have 2 weeks, this week and last week, and the prior week, we now started to develop a consecutive series of higher lows, higher highs. It's subtle. I grant that. It's subtle, but we are also starting to see a buildup of volume accumulation at this area. So when people look at this volume histogram, they're going to be, this market can't go anywhere because it's been going down on declining volume, and while we've had this subtle little rally, it's been on declining volume. But that's deceiving. And so what I'm looking at is I think that the market, while I'm not looking for a tremendous price increase, I do believe that from the seasonal aspect of the market, we will see an easy between 5 and 8% move in this stock. So what would 5% be? It's a $3.50 move that puts you almost, you know, at around 75 bucks. So the question you ask yourself is, when was the last time it was at 75 bucks? Draw a little line over there and you say, well, you know, it wasn't that long ago, April 1st, it was at 75 bucks. And you look at this from a technical perspective, and the volume histogram, even on a daily chart, doesn't reflect a lot of accumulation. And I like that because not a lot of people are using the volume on-balance volume indicator. They're using a lot of, still to this day, that volume histogram. When I look at this and I see a rise in the on-balance volume indicator, we do have almost a confirmed breakout. We broke out of that last swing high by just a few pennies. I'm looking at this as a potential of at least getting back to that April high, that's 75. Maybe we get a little bit more out of it. So number one, this is another trade that might last going into the early part of July. So I need to devise another strategy here. And if you think about it, if this stock was following the overall market in last week and the week before, when the S&Ps and everyone thought it was time to jump out the window and the world's coming to an end and the stock market's crashing and the sky is falling and selling may go away, you know, Starbucks didn't really go down.
Yeah, you had me excited. Yeah, you just had me excited about
And I mean, it's true, right, Donnie? I mean, just a few days ago, it's a matter of the light switch. One day we're bullish, one day we're bearish, and everyone thought the sky was falling, selling may go away, right?
It'll happen eventually. It'll happen.
Yes,
just give it.
I understand. It'll happen when the least amount of people are looking at it to happen. Anyway, and if you're interested in my prognostication, I think that this is going to be kind of like the 2007 year, where it happened in the beginning, right after July. You know, that earnings season. I still think that the longer term weekly charts are still intact from a bullish perspective, folks. But I think we see, and I think, Don, it will come. I think at the beginning of a correction is probably more likely in July I'm just going to throw that out there. But in the meantime, I think there's a lot of names out there that could see a nice little price recovery. And so with that said, these are some names that I wanted to throw out there for the audience and then say, okay, now how would we trade this thing? So first off, I'm going to go back to pass the baton back to Don. And we got two things we want to look at. A potential Q move. And here's the other thing. If you don't want to trade the Qs, that's fine. The question I have to ask everybody is what index is, I mean, obviously Starbucks, most people will know this answer already, but if we're bullish the NASDAQ 100, right, is Starbucks contained within that index?
Sure. Yeah, no, I get exactly.
Right? So if we're bullish the NASDAQ, then likely we should see performance relative to the index. So Starbucks just possibly could go up only because of the weight of the overall index effect of itself. So there's a couple reasons I like this trade. And so anyway, Donnie, let's take a look at the Qs first.
All right, looking at the Qs, one of the first things is, John, you mentioned a calendar spread. There's one interesting thing, though, that you have to entertain. In the June expiration, there was a kind of a funky dividend paid out in the Qs, and it altered many of the strikes. So I'm avoiding the June expiration specifically like the plague. It's just like a thing for option traders, especially with calendar spreads, because all of a sudden you have like a 91.63 strike. To kind of circumnavigate the funky strikes, as I call them, you know, you can select either like the Junes with 22 days left, and you can sell those against July's.
I think, Don, what I'm talking about is if we are looking for a quick little pullback by staying, but this is like this for this weekend. We've got Friday, which will be considered a half a day tomorrow, because I think every trader in their right mind at 12 noon is bang, gone. Saturday, Sunday, Monday, a little theta decay, and maybe an early week pullback. So maybe you can get a little calendar spread by taking some premium off the front month. And in a situation like that, that's where I would say a calendar spread could be an idea. Now let's work through and find out if that's possible. And you've just done what I think traders need to think of. The first thing you do is say, well, let's look at the June, and you see all these. Go back to your June option page. Now look at this. This is when you come to a page, folks, and you see 86.63, then 87, 86. That's what Don's talking about, that special dividend, and that can get a little bit goofy. So if that doesn't bother you, you know, now you could say, well, is it worth doing a trade? It all boils down to what's the risk. If the risk is worth the reward, then go ahead and do it if that doesn't bother you.
Yeah, no, you know, again, here's where the weeklies come in, and I'm like, well, you know, if I don't like the 29-day, I'll look at the 22-day, I'll look at the 36-day, and I'll open up the 22-day options. Looks clean to me. I mean, there's the 91 strike. I know you mentioned right in that neighborhood there of that 91 price range. To construct it again. So do I want to sell 22 days into 57 days, or do I want to sell 36 days into 57 days? And I'm actually going to show you both of them. I'm just going to go ahead and bring up the sell side first. All I did is hit Control click over there on the bid, and then I'm going to go to the Julys. I'm going to hit Control and again left click, and I just developed my calendar spread, and just a 91 call calendar for 59 cents. Now, as I was saying, you have the flexibility of you can use the June 2s. The June 2s, they got 22 days left. Or you could use the June 4s. Okay? And why might you want to use one versus the other? If you use the June 4 weeklies, okay, the June 4 weeklies have 36 days remaining. You're selling a little bit more time, a little bit more premium, if you will, into the option that you're buying, and it limits some of your upfront risk in the trade, and that's by no means wrong. If you use the June 2s, it's going to cost you 59 cents, but you have the capability of more rolls in there, and it gives you just that. It opens up the, hey, I can roll from the June 2s into, for instance, the June 4s, and you're skipping, again, the 29-day expiration. I can roll the June 2s into kind of the June 4s, then roll into the June 5s. I can even roll to the July 1s, the July 2s, and then eventually out. That's the one thing about calendar spreads. You can do this really simple with only one roll, or you can roll like every single week. It's amazing flexibility now in these trades. So I'll also take a look in the Analyze tab of this. I'll analyze the trade. But the reality is the peak that's being created here is not displaying all the capabilities and the roll opportunities, which, in case like you're wondering, like, what do you mean a roll? What is that actually worth? I always go back to the trade tab and I'll look at what the roll is currently trading for, the at the money roll. What's the at the money? Somewhere around like the 89 roll. And when the roll is looking again at the 89 strike and comparing, well, what's it worth? Well, this is trading for in the neighborhood of about 40 cents. That's the 89 call trading for about 40 cents. Then you got the 89, calls with 8 days remaining trading for about, let's call it, and I'm being really conservative here. Those are trading for about 70 cents. So one roll is worth about 30 cents if it hits at the money. So what I'm saying is that you have all these rolls and all this capability of rolling the 22-day option into a 57-day option. And each one of those rolls could logically be worth about 30 cents. And I didn't even use the analytics for it. All I did is I looked at what a roll was worth on a weekly right now. There's no better time to assess this than the day before expiration of these weeklies, because that is much more indicative of what you can truly roll a trade for. The Analyze tab, phenomenal. It's wonderful, but it's too perfect. People take this like, oh, I'm definitely going to make it. Yeah.
I'm sorry for laughing. That's a great comment.
It is. It's Disneyland of trading over here. It makes things like, it's a wonderful world, but the reality of trading is you're probably going to be somewhere in the neighborhood of 30 cents a roll. And that might not sound like a lot, but if you've got 3 rolls, 4 rolls embedded in it, it makes it worthwhile. And if you get that upward momentum towards that 91 strike, it can be quite a viable trade. Again, I looked at the 22-day option into the 57-day option, which leaves quite a number of rolling opportunities in there. And every time you think of a roll, you got to think of, hey, I only paid 59 cents for the trade. Every roll is getting part of my 59 cents back, and thereafter is all good, meaning that that's profitability on top of it. So the faster you can get your 59 cents back, the least risk that you'll have on it. And anytime we're trading anywhere near 91 is going to be the most effective spot. So in a market where we're grinding right now, these call calendars can be effective. And I'll tell you something, John, I have never really been an advocate of call calendar spreads on index products, because if the market goes up, volatility drops. But volatility, it's already low. I mean, the volatility it's stagnant, let's call it, dead. But that doesn't necessarily mean much more than options at this point in time don't have a lot of juice in them. And there's a reason for it. We're not doing much. I mean, you see things like the Qs moving a whopping 39 cents in a day. Sure, volatility is low. Volatility is an expectation. And apparently there's not many in this market over the next couple of weeks out there. So that's the Qs. We can flip it over to Starbucks if you guys would like. Take a look at
absolutely.
Starbucks.
Go with Starbucks. I got 2 more.
John, I got to tell you, Starbucks, it's one of my personal nemesis stocks.
Come on now.
There's a few. Everybody's got like nemesis stocks, right? Like one of mine is Apple. So I love every Apple product. But if I trade the stock, it's like anything I throw at that thing, comes back to haunt me. Starbucks, there was a period of time where, this is going back a ways, back in 2008, I looked at Starbucks when it was like $15 a share. I sold a bunch of naked puts on it, a bunch. I actually started, when it was at $18 a share, sold the 15 puts. I got put stock at 15. I just kept selling puts the entire way down, pretty much until, they called me. When I say they, the margin department called me and they go, you are long a lot of Starbucks. What do you intend to do with that? It is not a good thing when you work for a brokerage firm and the risk department is calling you. And at the time, I sat
Not a good, no.
I sat on the risk management team. So I made our email list every day. The email list comes out and it says, who has large risk? I do. Anyway, I got put a lot of Starbucks. Thing went all the way down to $8 in 2008, 2009. It bounced back up, but thought it was a genius when that thing bounced back up. I was so happy to get out of it. In any regard,
I got to tell you my little story back then, because it was around 850, and we loved Tom dearly, and you know who I'm referring to. And I was in Paris, and at the Technical Analysis Expo, and we had just been in London, and I go to London, and right across the street there was they had put a Starbucks in from Harrods. And I'm like, oh, Starbucks, I got to. So we fast forward, we go to Paris to speak at this conference over there, and they had a Starbucks on Champs-Élysées in the arcade. And the funny thing is that it was just jam-packed in that little arcade there, and it wasn't expatriate Americans, it was actually Parisians. French were like embracing the product. I come back here, I talk to Tom, I go, man, this stock, they are expanding worldwide, and about the only country they didn't go into was Italy. I mean, that kind of makes sense, but with the Italian roast thing. But I was talking to Tom, and Tom goes, I'll never touch that stock ever again. and it was like at $8.50. We have opposite ends of the story. I was digging it, and I think there's probably, I know maybe Andy or Arthur, a couple people here in the room. It was one of the top stocks that I was preaching from a pulpit. You got to get in. This company's not going out of business at $8.50, and now here we are at 70. And so, anyway, Starbucks to me, I'm looking for a potential. I guess you would say two things: a relative strength performance or sympathy play with the overall index, and a seasonality that goes with it. Someone asked another question about Green Mountain Coffee Roasters, and we'll take a look first. Let's just look at Starbucks individually. If I'm right, and there's at least a at the very least a 5% move in Starbucks over the next 30 days. And I think that you now need to look at the July expiration, because 30 days won't give you enough. What if we're a week early, a week late? So for a directional play, and I know that I need at least going into July to cover that move, what would be a decent strategy to look at for July? So the first thing Donnie did is he popped up today's option statistics, and we look at what's the implied volatility compared to historic volatility.
Yeah, I'm actually looking at the IV percentile, which is, it's just looking at like, okay, implied volatility in Starbucks. This is the 0 percentile, meaning that today is roughly the lowest implied volatility that has been recorded inside of the last year. And the actual stock price movement isn't far off that. So what can you say about Starbucks? It implied volatility-wise is completely dead, which is going to tell me I'm probably not going to go out there and be able to sell premium. So I'm probably going to have to use some type of a strategy where, you don't necessarily have to get long options. You might want to try to circumnavigate, though, any decay or any exposure. So two different ideas in here. Number one, you could absolutely use a calendar spread if you think we're going to grind higher. Okay, no question about it. But you have to be a little careful, because if you go even to the 75 strike, there's such little premium in Starbucks right now. It's like, well, if we go to 75, I'm selling an option for 20 cents in June. That's ridiculously low. And I'm not sure that you're going to love that idea. But then you go to the 72.5. We're not that far off 72.5 right now. And as John was just mentioning, if it does rally, it very easily can crest right past 72.5. So I'll flip it up a little bit instead of using the calendar spread, because there is, literally speaking, that little premium out there for Starbucks.
Right.
Here's where I'll go back to that kind of like binary trade in July and say 70, 72.5. I'm trying to do strategy here that limits my, number one, there's no volatility exposure in this trade. Number two, there's really no theta exposure. That's time decay, because I'm buying a 70 that's slightly in the money. It's in the money by $1.40, right? I'm buying the spread for about $1.33, and then I'm selling the 72 halves against it, because that's, again, that's what is designed to eliminate some of the theta exposure. It's a pure directionally biased play where roughly, I'm back to that risk a buck to make a buck. In this case, it's roughly risk a $1.33 to be able to make about $1.20. I call this the risk one to make one kind of trade. And that's the bullish scenario. Again, remember though, the 70s, they're already in the money by $1.40. So the trade, it's kind of what we call at parity. You know, you're paying for this trade precisely what the intrinsic value of the option you're buying is worth. And that's why it eliminates time value. Like, people do trades all day long and they just expose themselves to huge theta risk. You know, you realize you can do this trade for June. For June, it'll cost you $1.36. But for July, giving yourself even more time, it's not going to cost you anything more. It's actually going to cost a little bit less because it's an offset of time. All right, so think about that, because everybody always says options cost more for more time. That's not entirely true if you're using at-the-money spread. I even went out to August just to make a point. But if you like the July time frame, you stick with just that, the July time frame over here. What else you got today, John?
You know, I like the fact that, you know, sometimes when I'm a directional player and I'm thinking, okay, so it doesn't, what we did come up with is there's no real advantage to selling premium in this market because the vol is very low. End of story.
Yeah.
Do we agree on that? Okay.
Yeah.
And so options are pretty cheap. The problem that, and I think this is, it's kind of 10 to 1 to the other. If I have the ability, and I think this is where a lot of traders, I don't know, Donnie, if you would agree with this, but I think a lot of traders lack maybe analytical skills to put an edge in their pocket for being more timely and timing directional trades. Would you agree with that?
Absolutely. Yeah.
And I'm not saying I'm perfect. Yeah. And I think that's absolutely true. That's why it's not direction, it's more duration. You know, if you can survive the move. That's why sometimes a weekly option, you might have the right idea and weekly options look great, but then you just needed that extra week, and then you, God, if I only had that extra. So duration is kind of important. And that's where I think that, you know, there's a couple, that's why we combine, it's not just one indicator. And they always say if you can put together a listing of the best indicators out there, make sure that you're not doubling up on an indicator that's very similar to the other. Like if you used a 10 and 20 day moving average, and if you use MACD, you're pretty much using two of the same indicators, because the MACD uses a 12 and a 26 period moving average component. And if you're using a 10 and 20 day, 10 and 12 is not that much difference, and especially 20 to 26. So you're using two of the same indicators to come up with the, you know, wanting confirmation. So in other words, I like to use different indicators. Seasonality is, as many of you already know, one of my top studies. I also use, as you can tell, my person's pivots, and then my momentum indicator, the PPS, to give me defined momentum breaks, bullish and bearish signals. So with that said, when I'm looking at a stock, I want to know, well, what's the seasonality of that sector and that index, because that will help me with my timing element. And person's pivots, it also gives me an idea of whether the market can move within a certain price target within that time frame. And so that helps me to capitalize on being a little bit more correct in my timing element. Of course, there's one of my great patterns, the high close doji, low close doji. That helps me with the timing element. I should start to see immediate results. If I get a high close doji, I want to see performance within at least no more than 2 time periods. I should start to see positive performance on that signal. So there are a few things that we can use to help the analytical process up. It's just a matter of now whether I can get into the trade, and that's where using the TOS analyzing tab and then using these options to say, hey, listen, I don't want to put down you know, $70,000 on a trade for the next week, whereas I could maybe use maybe less than 1/20th of that capital and apply a good option strategy for this particular move. And so I'm looking at Starbucks and as a 5% move between now and July, and with the fact that we have implied volatility, it almost makes sense to just get an outright call in this situation, because if the move happens and it pops up, I don't want to be locked in with an outright call spread, but by going with the in the money kind of, or at the money slight bias with the call spread, that'll give you a better advantageous position. So it makes sense in this situation. Don was 100% correct in saying, listen, this option analytics is not giving us an advantage of an option writing strategy. And so with Starbucks, I think that you have two ways to play it, and you can go with an outright stock replacement strategy, which may require a little bit more capital, or look at the call spread if you so like, but I think the call spread that Donnie picked out, the 70, 72.5, makes a lot of sense there. All right, so now let me go over, and I want to pick out one more chart here for you guys, because I think this is kind of a neat thing, because we were just talking about, if you notice that we focused on the Qs today. And when we were focusing on the Qs, and obviously if you saw the Starbucks, Don, I'm sorry to take it back so fast because I would have had you showed today's volume action in Starbucks. Obviously someone was looking at Starbucks today too, because if you look at your the analytics tab, you'll note that even going out to August options, there was some volume both in June and August strikes. All right. You guys can go through that and look at that yourself. What I want to show you was another stock that is contained within the NASDAQ 100, and it's Amgen. And Amgen right now, this is a weekly chart, will actually create a not a double. We had a double doji star formation, and then we're going to see a close above the highest high of both dojis, and that would be this level right line in the sand right here. This is the last conditional change. This is the bar, that high right up in here, and I'm going to take this over to a daily chart. You'll find why that transposed from weekly to daily. Note that this is the April 10th high. There's something about April 10th that happened in the market, April 10th, and it was like the light switch went on. And since then, the market has really stayed below that April 10th high, which is where I think the market's going to want to try to come back to test one more time. Looking at Amgen, it's obviously in the NASDAQ. We have a consecutive series of higher lows, so we're starting to build a bullish trend. We've been in this sideways price range now for what? I mean, count them up with me. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 days, 18 trading days. I mean, that's a significant time. And throughout that whole time period, you can see where, I don't know what this volume histogram's telling you, but maybe, I don't know, you could build a case. I don't know what case you can build, but the volume histogram's giving me useless. I don't have any information. I have maybe information here that tells me that that day was sold off on high volume. Okay, great. But what about the trend of the market? The trend of the market, this isn't really telling me much of anything. If it tells you something, shoot me an email, let me know. In the meantime, what on balance volume indicator is telling me is that this market started to go sideways and the volume started to make a higher low. Now, someone had pointed out, but it's also making lower highs. It's compacting. In a bullish trend, you want to see higher lows at the very least. And at the very point of breakout, note that this market broke out of this little wedge. Would you agree with me and say this day right there? If you point out to that day, that point right there on the chart, and you'd say, yeah, that's the day. So they were actually accumulating positions, a little pickup, and the very next day, look what the volume analysis shares with you on this day, which is May 19th. May 19th, you saw a breakout of the volume. Does everyone see that? Clear as a bell. If you don't see it, we need to maybe get a microscope, because you can clearly see there was a breakout. If this yellow line, folks, if this yellow line was price, you would be buying a breakout in the market. I don't think anyone would disagree. So it is true that volume precedes price. In other words, the volume started to break out, and then all of a sudden, 1, then 2, and then there it is. There's your rally 3 days later. So the moral of the story is that Amgen started to you started to see an accumulation of positions back on the 19th, according to the OBV indicator, which is kind of cool. Our indicator popped into a buy on yesterday's close, and now the market's proceeded to move up. Amgen is also contained within the Qs. When I turn this over to a weekly chart, it's interesting, as I pointed out earlier, we have a high close doji. So if there's a potential for a pop in Amgen, if tomorrow we close here and you get a slight pullback next week that holds at around, let's call it 113. I don't want to see the market, I want to see a continuation of higher lows. So a slight pullback next week, your risk is if the market makes a newer low for the week, we should see a continuation to an upside target of at least test that April 10th breakout high. So Amgen is one of those trades that or stocks that is optionable. It's contained within the NASDAQ 100, and we also will pop up one of my favorite bullish chart patterns, which is the high close doji. If you take a longer term view of Amgen, and this might be underneath everyone's radar scope, but we've seen the biotech sector weigh in on the NASDAQ, and that's the one sector that if all of a sudden you start to see a recovery in the biotech, it's the one that can take the NASDAQ to newer heights. So by looking at this chart, friends, you take a look at all the way back since last year. Yeah, it got a little overvalued. It came back into this little old support resistance area, right? So all this area right in here, old lows, and it's all it did. And now we're starting to see a shift in the momentum with a little bit of on-balance volume indicator giving it a little bullish attitude. So to me, I think there's at the very least, a pullback. There's about a $7 move, and I find out on almost a $4 breakdown. In other words, if the market breaks that low, I got on a stock trade here about a $4 risk for a potential $7 reward, and that makes sense to me. And the time horizon on that, if this is on a weekly chart, and if it does prove to be the high close doji, remember 1 to 2 time periods. So I need at least 2 weeks for the trade to mature, number one, right? So that leaves me maybe 21 days if I'm a week early or so. So with that said, what I would suggest to everybody is for a potential trade, Donnie, I'll put this back to you. The end of June, there's only 29 days. You don't have enough time. So this would be another one that we would want to take a little look-see going forward into if there is number one. And the first thing you do is go up to your trade tab and find out, is Amgen a popular stock?
Yeah, let's take a look at some of the option statistics. I mean, when people ask like if it's trading options, the first thing I do is I look at the option stats. Well, traded 6,000 contracts today, but today doesn't necessarily mean anything because nothing traded today, right? I also see low implied volatility again, really low. Like, I just got to keep pointing that out. Everything is at like low implied volatilities. That doesn't mean the market's just going to turn around though. Low implied volatility can stay low for years. Take a look back at the VIX from 2004, 2005, 2006, 2007. You need to go no further than that. The question I have on Amgen, it's because I haven't necessarily looked at it. I'll open up the weeklies.
Yeah.
I'll change my information layout to volume and open interest. It's fair. I mean, the liquidity in here is fair. And that's fair. Yeah, it's fair. It's not.
No, I agree. I'm 100% behind you on that. It is. It's not, and that's the thing. We've just done a lot of work, or not a lot of work. We've done some work. We've looked at the Qs. If I'm right and it has a 3% move, what are the components that are going to make the market move? And we just took a little digestion of what's underneath that index and where could the strength come that pulls the market up. And if it's coming from these individual stocks, then how can we participate in that? And that's where we do our homework.
Right, and I'll dig into the interesting thing about weeklies is that volume hasn't just picked up in the weeklies and many of the underlyings. Today, volume in the weeklies is larger than the primary expiration, and we don't necessarily see that per se in Amgen, but overall the markets in here, they're not that bad. And I'm looking at a one-day option specifically because I want to know for instance, if I use these 22-day options, right? If I use these 22-day options that have, 10-cent plus wide markets, we're a little bit wide, right? But I want to know what they're going to look like right before expiration. And they actually tighten up. The more liquidity is, the tighter the bid-offer spreads are going to be. It's just more competition, on either side of the marketplace. So with this, again, you probably don't want to mess around with the idea of selling a huge amount of premium, since premium as at a bare minimum in here. So you go, again, right back to the well, and you go, well, how can I construct a strategy that surrounds, this price that's a little bit bullish or bearish for that matter, if you look at the trade a different way, and you start to build it. And I'll build a vertical. The first thing I do is I build just a $1 wide vertical, and I typically flip them to $2 wide vertical. And what I'm looking for is about a risk one to be able to make one scenario without risking any, what I'll term, extrinsic or time value. If you look at the 14 calls, okay, the 114 calls are already in the money by roughly 86 cents, and I can buy the spread for about 98 cents. So this thing is almost at parity. That is, again, it's trading for its value. It's risk a buck to be able to make a buck. So that is one of the strategies. And again, if you don't like that idea, the reason I use these risk one to make one, John said a phrase earlier that I really picked up on, and I say this all the time. Like, I say this probably once a day. Duration over direction. The reason I actually use these strategies will risk a buck to make a buck is all too often we see clients that are like, well, let's risk 5 to be able to make 1. That's not wrong. But when the pressure's against you, you're going to fold. Or they'll go out.
Sorry for laughing. It's, I'm sorry for laughing, Donnie. It's true. It is.
So I finally come like full circle, and I'm like, you know what? Just go out, risk a buck to be able to make a buck, and then the directional bias. Because if you're doing like every trade and risking a buck to make a buck in that scenario, the most important thing becomes your own directional bias. You just have to get that logic down. And then when you think duration over direction, listen, they're easy premise. If you're going to risk a buck and you're going to do 5 contracts, be willing to part with the full $500. If you don't like losing $500, don't do 5 contracts. Just do 2 contracts, do 3 contracts. I don't care. Nobody else cares either. It's an electronic world out there. So keep that in perspective. It helps you manage the risk. If we're completely and totally wrong in Amgen in the next 2 weeks, you may still be okay because you got 36 days to pull this thing out. And that's
and you don't have to risk. And that's the thing about that, Donnie, you didn't mention. I mean, you're risking 1 to make 1 at the maximum risk. You don't have to risk all that. And I said, if this market, if it completely fails and gets underneath that 110, right, then you're wrong and you can get out. Are you going to lose all your premium on that trade?
Right. And
next week.
You know what?
If it happened next week, if the market crashes and goes to 109 next Friday, and 10 minutes before the close, you go, John said if this made a new low on the week, this isn't working out, get out. Would that option at 109 lose all its premium? Would that strategy be 100% worthless? And the answer is no.
No, still going to be some time value in it. But moreover,
right.
You're still intact. You knew what your risk was getting in. Like, there's no surprise. Ooh, I lost a buck. You know what other people do, though? They'll go out, and you know this, John, is they'll build the stock trade, and they'll put the stop order in there, and they'll get stopped out, and then the stock will run their way. Like, you almost have to look at this as this trade has a stop order built into it. It is a spread. You know what your risk is. So unlike stock trades where you buy the stock at 115, stock backs off to 111. It backs off just far enough to stop you out and then runs the other way. You're not going to get that with a spread. You're going to get the 36 days that you paid for in the spread, nothing more, nothing less.
Well, that kind of wraps us up. I wanted to just say, hey, we had a couple things here. I haven't heard your voice in a long time. Don's got another one on the way, folks. He's becoming a real professional dad, and I just wanted to say, Don, it's I missed you at the Money Show this year, and I know we'll cross paths. And I wanted to say thank you for your time coming in. It's always nice to hear Our friends at Thinkorswim come in here, TD Ameritrade Thinkorswim, and get people, charged up. There are some moves that are coming up, and for those that are here tonight, if you would like to come in, we're going to do and follow up tomorrow morning. I'm going to follow up on a few trades. If you guys want to just come in and spot check us and see us tomorrow morning, use the same login. You guys can come in tomorrow for the trading room. We'll go over a few setups and some trades. I thank you for your time, Don. I hope everyone got a little bit extra out of this, at least at the very least a little confirmation of what's going on with the market and how to use maybe some option analytics to decide whether there is decent risk reward in some of the trades. And we can always find opportunity. It's a matter is if the risk doesn't look like the reward, then don't do the trade. Otherwise, there will be another opportunity. It just is a matter of rolling up the sleeves and start digging. And I think we had a little dig session today. So thank you so much, Don. And everyone, did you enjoy that? Did you enjoy coming here and hearing Don?
I hear the applause, the clapping.
I hear the applause. Look at him. There it is. There it is. Look at this, Don. All right. So we did record this, so you guys will probably get this out within the next 24 hours. That's number one. Number two, you want to come in. We start here first thing in the morning, 9 a.m. Eastern, a half hour before the market, because we do our planning and scanning or looking at our trades and what we're talking about. So if you guys want to come in tomorrow morning, love to have you. We'll see you guys here tomorrow, Donnie. Until our paths cross, we will see you next time. Everyone, have a great evening. Bye-bye now.